Hi, dear all. Thank you for liking, subscribing, and watching my videos. This is an educational channel. I know that it is not in the way that when you are enjoying or just going for entertainment purpose. This video is only for your knowledge purpose. I am trying to give you a good knowledge related to the topics those I am presenting in a video. And with your likes, your subscribes, I really encouraged. Thank you very much. I'm appreciating you from my heart. And in the sequence of my videos today, I'm going to be discuss share or stock valuation. Stock valuation is a today's video topic. Topics are going to be covered under this video are meaning of stock, type of stock, definition and characteristics of equity shares, definition and characteristics of preferred stocks, preferred stock features, preferred stock valuation, common stock valuation based on the holding period valuation, single holding period, multiple holding periods. These are the topic what we are going to be covered under this video. Let's start with the meaning of stock. A share is a single smallest quantity of a company's stock. It means once we are going to be discuss about the stock, we can say that when we are purchasing the shares, a number of shares in one person's hand or one company's hand is known as the stock of share. So if you are allocating up stock and referring to specific characteristics, the proper word to use is share. So it means we can say that whether we are using stock or word share, both are reflecting to each other. If suppose I purchase X company's shares, suppose 10 shares, so I can say that I have a stock of this company share. Okay, so we say that I am the owner of or equity holders of this company share or preferred holders of this company share. Let me explain what is preferred and equity in the next slide. Please continue with me. In explanation or in more explanation, we can say that as a share is an individual unit of capital expressing the ownership relationship between the company and the shareholders. So it means the share is a part of relation between the company and owner. So we can say that when we want to join together a owner and a shareholder, the jointing part is share because we are purchasing the shares, so both are associated to each other. The dominated value of share is its face value. Face value, if you remember that in previous video when I present the valuation of bond, that time we'll discuss about the face value, par value, or how we are going to be calculate or evaluate or recognize any security. So in a video we discuss about the bond. Now we are discussing about the share and stock. This is also a part of security. Let's continue. We can say and the total of the face value of issued share represent the capital of the company. It means whatever total number of shares company issued in the market, it is a total capital against the stock or against the share companies are having against the we can say the securities. Securities are representing also we say that bond as well as stock. So stock securities are bond securities. Bond securities we already discussed in the previous video. If you have any doubt, please go through that video. You will get all information in a broad way. Let's continue here. In conclusion, we can say that the stock are shares in the ownership of a company. Let's move. We'll discuss about the type of stock or type of shares, means what type of shares are available in a company. So as per the Companies Act, a company can issue two type of shares. Number one is an equity share, that is also known or called as an ordinary share or stock or common shares. And number two, preferred shares. So preferred stock or preference stocks are common. Let's start with the equity. We can say that ordinary shares are common shares or stock. So definition, equity shares are those whose holders are owners of the company and they bear the risk of the company. So we can say that the equity shareholders are the real owner of the company and they are bearing all activities, all risks are there when they are issuing new product in the market. So whatever associated risks are there, only equity shareholders are responsible to bear it. Whatever losses are there, whatever profits are there or gains are there, they will be enjoy or suffer as characteristics of equity shares. Holders are the owner. So first thing is that because we discussed in the definition as well, equity shareholders are the real owner of the company. So they are known as owner. Carrying voting right. They are having voting right. What the meaning of voting right? As we say that maybe the millions or billions persons are the owner of some big companies. So who will be run the company? So normally, as you know, that corporations or big companies are running by the managing directors or CEOs or the board of directors. So these persons are electing through the votes by the owners of the company. So this is reflecting their voting right. And not only here also, when companies are going to be start a new project, going for a new type of business, they need to concern with the owners. So that time owners voting right is required. Okay, hope you understand. Can be elected as a director. So any owner can be elect themselves as a say that I want to be a participate in a company's activity directly, not indirectly like giving the money and just watching from outside. No, I want to work as a internal part of the company. So even though they can be elect themselves or maybe others as a director. Return on capital is made at the end of every other category on the on this class is companies is liquidated. Liquidated means if companies is going to be closed and company is going to be wind up their all properties, whatever money or capital company will be collect, that is known as return on capital. So that return, when owners means board of directors or the persons those are running the company, they will pay to everyone means all credit holders, even though owners. At the end, it will be goes to the equity shareholders. This is the risk position what we discuss in the definition. So this is the risk they will get their money at the end if anything is left or whatever will be left. Hope you understand. So preference share or preferred stock, as you know that this is also known as preferred stock or preference share is a common word. Definition: a share which entitle the holder to a fixed dividend whose payments take priority over that of ordinary share dividends. In other words, we can say that which carry three preferences as follows. Preferences on whom? Preferences on equity shares because both are the owner. So let's see what preference they are having on equity. Number one, dividend rate is pre-quoted. As we didn't discuss anything on the equity share will get any benefit whatever left after paying everyone as we discussed there. But preferred stockholders, they have a fixed amount of dividend they are going to be received every year. So that's why they are having pre-quoted dividend. What is the meaning of pre-quoted? Let's go for example. For example, 12% preferred stock means dividend rate is 12%. Okay, so it means 12% every year they will get as a dividend on their investment. Number two, they get their dividend before equities. So this is the priority. What I said told you, they will get benefit before the equities. Number three, if company goes into the winding up as a liquidation we discussed before, capital of the preferred stockholder is returned to them before any payment to the equity shareholders. This is a preference on equity again. Let's go for the characteristics of preferred stocks or preferred shares. Preference shareholders are the owner. Like a common equity shareholders, they are also owners because both are having share of the company. So both are known as owners. On these shares, rate of dividend is quoted as the time of issue. The difference is only that preference shareholders have a pre-quoted dividend rate. Number three, preference to holders at the time of dividend distribution and return of the capital. So they are getting preference, means holders are getting preference when companies are going to be pay dividend, distribute dividend, or pay any capital amount to the shareholders. So they will get preference on whom? Again on equity. Hope you understand. Preferred stockholders features. So let us discuss what the other features they are having. Firm may have multiple classes of preferred stocks and each with the different features like. Here I will explain to you that different authors are explaining the shares in a different way. Here just I brought in this video some common features, those usually using by the all persons or authors as well as students. So let's carry on the basis of priority. Lower than debt stocks but higher than common stock. So what the meaning of lower than? It means if any situation will become, so first payment will go to the debt stockholders, then preferred stockholders, and then common. So it means preferred stockholders are in between debt and common stock. So this is the priority level in all stocks. Cumulative features. All past unpaid preferred stock dividend must be paid before any common stock dividends are declared. The meaning is there, if last year or previous years, if because of any situation, company are unable to pay any preferred stock dividend and now they are going to be declared the payment. So it means they are not going to be paid only for this year dividend and they will pay to the owners. No. First they have to pay all dividends from the past years to the preferred stockholders, then whatever balance profit is there, they will share with the equities. This is another important feature. Protective provisions like common stock. So they are protected as common stock, so they will be treated as a owner of the company. Convertibility. Many preferred stocks are convertible into the common stock, but normally this is a conditional issued. When company issue the preferred stocks, they are mentioning during the issue time on that security, they can convert or not. So once it will be mentioned there, they can convert. So it is known as convertible shares. Adjustable rate. Preferred stocks have a dividend like a debt interest rate, means fixed rate. So their rate is fixed at the time of. In continuation with the feature, we will go for the next, that participation. Some, very few we can say that. Preferred stocks have a dividends based on the firm earning. So the second, pay in kind. Pay in kind means preferred stock pay additional preferred shares to the investors rather than cash dividend. Retirement. Most preferred stocks are callable and many include a sinking fund provision to set cash aside of the purpose of retaining preferred shares. So it means company can call the shares and just ask them to return their shares and they will return the money of shareholders. So the retirement condition is also mentioned when the companies are issuing preferred stocks to the holders. Let's start the preferred stock valuation. Preferred stocks. These stocks usually sold for $20, $50, $100 per share. Sometime may change 20, 10, different values are there. It's depend upon the company to company, how much they want to issue or what they want to take against one share. Dividends are fixed either as a dollar amount or as a percentage of par value. Look here, when we say that fixed amount, it is not fixed. Fixed means percentage or amount. Any one could be fixed. So whatever fix is there, they will get at the end of the year. For example, ABC Limited issued $75 million preferred stocks, 8.25% at the rate of 100 per share. So it means $8.25 is a fixed annual dividend per year. As I told that it is mentioned before the preferred stocks, what interest rate or what fixed rate they will receive. So here as percentage is mentioned, so it means at the end of every year, whatever profit is there, company will give against the preferred stocks amount 8.25% dividend. So we can calculate also. So we can calculate the amount of dividend paid per year as below. Simple valuation formula. We know that we are calculating interest with the same formula, same as dividend. Dividend amount, normally dividend we are representing with the word D. In future we will continue with the D, is equal to par value of stock, means share, multiplied by dividend rate. So suppose we will go with this example. Par value of the share mentioned here, the share we issued at $100, and the dividend rate is 8.25. So we can say that $8.25 per share will be paid every year to these type of shareholders, or those are invested their money in this. So in continuation, we'll go for a formula to understand how to calculate. First, we have to understand a preferred stock can usually be valued like a perpetuity. It means it is indefinite life. Once you invested, and if it is not mentioned that how long, the company, according to the company's life, your investment is there and you will get dividend till the life of the company, means infinity time. Formula for preferred stock valuation is, we say that VPS is equal to D divided by KPS. Let's explain that what is VPS. VPS is equal to value of preferred stock. Whenever we are calculating value, we are using the V. PS is representing the preferred stock. Here D is representing the dividend amount, and KPS is representing the required rate, or we can say that cost of preferred stock. Keep in your mind, when we will start the new video cost of capital, that time we will use K word with the cost of stock, and there also we will discuss about the preferred stock. So as my videos preference, whenever I am delivering any formula, must be solving through an example for a better understanding. So let's understand with me with an example. ABC Limited have preferred stock $50, pays an 8.25% dividend annually. Suppose our required rate of return on ABC's preferred stock is 9.5%. Let's go for the solution and first deliver the formula. Here VP0 means value of preferred stock we need to calculate. D is equal to, you know, that is the dividend par value multiplied by dividend rate. So we need to know dividend amount. Par value is 50 and dividend rate is 8.25. It means dividend amount is $4.125 per share per year. Required rate of return 9.5. It will be converted, then it is 0.095. Let's deliver the values in the formula. So VPS is equal to the dividend amount 4.125 divided by the required return, that is 0.095. It means the value is $43.42. So this is the value of this preferred stock after a year, or you can say the present value of the preferred. Now we calculated the value. If suppose we know the value, or we want to know that what percentage we are receiving against our stock, so it is known as expected rate on preferred stock. Let us first manage the formula. So just adjust the formula. We know that KPS is equal to D upon P0. Just what we did, we cross multiplied. You remember that P0 is equal to D upon KPS. So just only it is a changed. So here we can say that VPS is equal to P0. VPS means value of preferred stock, or P0 is also value of preferred stock. So we can use both terms in a replacement way. So it doesn't matter. Here, as you know that D, always we say that this is a dividend amount, and KPS is equal to required rate. It is also known as cost of preferred stock. Cost of preferred stock we'll discuss when we'll discuss about the cost of capital chapter. So same thing we are going to be discussing, same formula we'll discuss over there. keep in your mind. So this video is also important and reflecting your cost of capital. Let it be here with the solution. For example, we'll take an example to deliver this formula as well. If we know the preferred stock price is $40, like before we calculated the price, but now we know the price, and the preferred stock dividend is $4.125, and the expected return is, now we need to calculate the expected return. As we'll put the formula, KPS is equal to D upon P0, and the value of D is 4.125, the value of P0 is 40. So it means our required rate of return is 0.1031 or 10.31%. So if we are having values, we can get to know that what percentage we are going to be received. So this is the analysis of preferred stockholders. Now we'll go for common stock valuation, means equity stock valuation. Let us start with common stock valuation. It is based on the holding period valuation. Because as you know that common stocks or the owners of the company, so they are carrying the share for a long period, may sometime perpetual life, means infinite way, or maybe sometime they are selling in between because of secondary market is available. Let's understand. As an investor side, suppose you buy a stock today at present value P0. Means you are having company, you are issuing security to the investors, and the value of your share is, suppose we are reflecting with P0 because beginning of the year you are issuing. Then you sell it 1 year from today. Again you are selling that at the price of P1, means price change. It is not the same price, that's why we are not using P0 here. We reflected with P1, and you receive dividend D1, means after first year when you receive first dividend, you will reflect with the D1. A second year, definitely when you will receive, it is a D2, and so on. So during the holding period, thus you received two cash flows. Means once you invested in any company, you received two cash flows. What you received? You received price of your share. If you withdraw the share, you will get the price after 1 year, whatever price in the market. And you will receive also dividend for first year. So price of 1 year we are reflecting with P1, and dividend for first year we are reflecting with D1. So we can derive the formula as below. Let us see how we have to go for the formula or analyze the formula. VCS, C means common stock. Here we are using the word common stock. Again, I am telling to you, this is just information. Different pupils are reflecting in a different way. Common stock, equity stock, so you can say that QS as well. Okay, or ordinary stocks OS as well. So it is not going to be affect. The value means what is written at is important. So VCS is a value of common stock. It is D1 divided by 1 plus KCS, means cost of capital of common stock, plus P1 divided by 1 plus KCS. So now the formula is we are calculating the value of D1 as well as the calculating value of P1. It means what is the present value after 1 year of dividend, after 1 year of price. Same as if we are going for further, we have to go again my video time value of money. You can go for long period calculation. We are using the same formula. This is for 1 year. So let's explain the formula here. As you know that VCS, we can reflect also P0, as we said that any value we can share with P. So any value when we are reflecting or we are calculating, we are using the word P. Here 0 is reflecting for the 0 year, or we can say that VCS, both are same known values. Don't be confused in future whenever you are going to see or look the other books from the other authors or videos from the other YouTubers as well as your teachers. Value of common stock is reflecting this. D1 is equal to the dividend at the end of the period 1. And P1 is equal to the price of stock at the end of the period 1. As you know that KCS no need to define because it is a required rate of return. Let's come for the common stock valuation. First we will discuss about the single holding period. It means once you hold, you are not getting the multiple dividends. You have one particular time of keeping the stocks in your hand. Let's understand through an example. For example, suppose you expect from ABC Limited common stock to pay a $5.50 dividend at the end of the year. At that time, the stock price is expected to be $120. So if your required rate of return is 15%, what would you pay for the stock now? It means at what price you are ready to purchase stock now. So we need to know the present value. So before delivering the formula, we have to know that what informations are given in the example. This is a very easy way to solve any problem. If you are going through it, you must be understand which formula what we are going to be used and what the component values are associated with the example. So here we are going to be calculate the value of common stock, means VCS. D1 is given here, it's 5.50. P1 is also given because after 1 year the price would be $120. Cost of required return or cost of common stock is given 15%, or we can say 0.15. So let us drive the formula or put the value in the formula. So VCS is equal to dividend 5.50 divided by 1 plus K, 1.15, plus again 120 P1 divided by again 1 plus K means 1.15. Just solve the value, you will get the value would be 109.13. So this is a single holding period bond form. Let us go for the multi-holding period. So first we'll understand that what the meaning of multi-holding period. Constant growth model. Multi means your bond is growing. So it means growth rate would be the part of that multi-holding periods. So assume common stock dividend will be grow at a constant rate into the future. Let's put the formula VCS is equal to D1 upon KCS minus G as well. Here we are going to include G value. G is reflecting what? I will explain you here. D1, the dividend at the end of the period, beginning previous formula I already explained to you. KCS, the required rate of return on common stock, you know it. G is equal to the constant annual dividend growth rate. This is a new thing what we brought here. So we need to solve as my practice. So let's go to understand through an example. Suppose ABC Limited stock recently paid $5 as a dividend. The dividend is expected to grow at 10% per year indefinitely, means unlimited of time. Every year it will be grow by 10%. What would be the willing to pay if our required rate of return on ABC's stock is 15%? So at what rate you are ready to buy this stock? As a previous you are ready to buy at 109. Approx now what you would be. So let's put the values in the formula to understand that what we are going to be get. First we have a D0, it's given $5. So we need to calculate D1 because the formula is showing D1. D1 means the D0 multiplied by growth rate. Growth rate means 1 point growth rate. 1.10 is your growth rate. It means your dollar value, dividend value in dollar is 5.50 after a year. Let's put that value in the formula. VCS is equal to D1 upon KCS minus G. So here we have 5.50 divided by 0.15 is your KCS, means required rate of return minus growth rate is 0.10. So the value is $110. So at 110 you are ready to buy the stock. This is the understanding. Hope. Now we have to go to understand that expected rate of return. So in both situations we understand that how to calculate the value. Now if values are given, how to calculate the percentage, as we discussed in the preferred stock also. Let it be. So here just adjust the valuation formula first, because this is a big formula, so I will give you all adjustments. VCS is equal to D upon CS minus G. So let us see, just type this formula in new way. So we can say that KCS is equal to D1 upon P0 plus G. So once you will adjust the formula, you will get the value in the same way. So this is the new formula after changes the values. So here what we say that just only the replacement of VCS is equal to P0, because as I told you that whether we are calculating the value of the bond or price of the, value of the share common stock or price of the value share common stock, both are equal. So just only this is a replacement in the formula. Again, for more understanding, please come with me. Example. Let's understand through the example. As always, I'm telling you this is a repeated word. Suppose that a stock will pay $3 dividend at the time 1, means after 1 year, and has a price $27 if expected growth rate is $5. What is the rate of return? So here we are going to be calculate the rate of return. So we will use the direct formula KCS is equal to D1 divided by P0 plus growth rate. So let's put the value KCS is equal to dividend is 3. They are mentioning after 1 year, so there is no need to calculate, adjust with the growth, divided by the price is also given for the current year. So P1 is given 27 and plus growth rate is G.05. So it means the interest rate or the required rate of return is 16.11%. So hope you understand. This video is in a very easy way. I just brought only a few examples for understanding. In future, definitely I will bring more videos for your understanding. Be with me always. I am maybe you're a good teacher, you will like always my videos, but don't forget to like and subscribe. This is always request from you. If you like my videos, my lectures, this is my encouragement, and don't forget to subscribe as well. Your subscription is also encouraging me to produce a right and good videos for your choice. So most probably you will get soon new videos for more understanding. This is an educational channel and I'm your teacher to teach you all topics, all related topics related to finance and accounting as well. Bye bye. See you in the next video.